Right now, as you watch this, something is moving inside the silver market that has not moved like this in years. A number that was screaming shortage for weeks just went quiet suddenly without warning. And the last time something like this happened, the people who understood it first made decisions that changed their financial lives forever. The people who ignored it wish they hadn't. You have the next 17 minutes to decide which one of those people you want to be. Welcome to John AG, the channel where serious people come to understand what the world's money is actually doing, not what the headlines tell you it's doing. Now, before we go any further, if you are not yet subscribed to this channel, think of it this way. You know that wise old friend, the one who has been around long enough to know when something important is about to happen, the one you always call first when the news stops making sense. That is what this channel wants to be for you. So, do your future self a favor right now, hit that subscribe button and tap the bell. Because the kind of information you're about to hear is not the kind you want to miss, simply because the algorithm forgot to tell you it was here. And one more thing before we begin, drop a comment right now and tell us where in the world are you watching this from. Are you in London, Lagos, Lahore, Los Angeles? Because this story touches all of you, every single one. For several weeks leading up to this moment, the global silver market had been sending a message. It was not a quiet message. It was not a subtle one. It was the kind of message that serious economists and market analysts look at and immediately begin making phone calls. That message was written in a single number, the Shanghai Silver Premium. To understand why that number matters, one must first understand how silver moves around the world. Silver is not simply bought and sold in one place. It trades across multiple exchanges simultaneously. In New York on the COMEX, in London through the OTC market, and in China through two major platforms, the Shanghai Gold Exchange, known as the SGE, and the Shanghai Futures Exchange, known as the SHFE. Each of these markets reflects local supply and demand conditions. Under normal circumstances, prices across these markets stay relatively close to each other. Small differences exist, but they are minor. They are manageable. They're expected. But what happened in the weeks before this update was not minor. It was not manageable, and it was certainly not expected. The price of silver in Shanghai began trading at a premium, meaning Chinese buyers were paying significantly more for silver than buyers in New York or London were paying for the exact same metal. At its peak, that premium reached somewhere between 10 and 15% above the Western benchmark price. In practical terms, this meant that if silver was trading at $100 per unit in New York, buyers in Shanghai were willingly paying $110 or even $150 for the same unit. This is not how efficient markets are supposed to behave. When a premium of that size opens up between two major markets, it carries only one real meaning. The buyers in the premium market cannot get enough of the physical product. They are not paying more because they want to. They are paying more because they have no choice. The metal they need is not arriving fast enough. The supply chain connecting the Western vaults to the Eastern warehouses is under serious strain. For weeks, that strain was visible to anyone paying attention. Shanghai was not whispering about a shortage. Shanghai was announcing it loudly in the only language markets speak price. Industrial manufacturers in China who depend on silver for electronics, solar panels, and medical equipment were feeling pressure. Financial institutions that use physical silver as a store of value were competing for the same limited supply. The premium was the thermometer, and the thermometer was reading very high, and then abruptly it changed. The number that had been rising, holding, and signaling tightness for weeks collapsed. Not gradually, not slowly, but sharply and suddenly in a window of time so short that most casual observers would have missed it entirely. That single moment, that abrupt change, is what this entire analysis is built around. Because in that one movement, three entirely different stories became possible, and only one of them is true. There's a principle that experienced market analysts return to again and again, particularly in moments of confusion and rapid movement. It is this: a market does not break suddenly. It breaks slowly, quietly, almost invisibly, and then all at once. The fracture that the world witnessed in the global silver supply chain in early 26 did not arrive without warning. It arrived with weeks of warnings that most people either did not see, did not understand, or chose to ignore. To understand the full weight of what happened when the Shanghai premium abruptly changed, one must travel back to where the cracks first appeared, not in China, but in the vaults of New York. In the opening days of January 2026, something occurred on the COMEX. The Chicago Mercantile Exchange Commodity Division and the primary American marketplace where silver futures contracts are traded. That sent a quiet but powerful tremor through the professional trading community. In the span of just 7 trading days, approximately 26% of COMEX's entire registered silver inventory was physically withdrawn for delivery. One must sit with that figure for a moment. Not 1%, not 5%, not even 10. In one single week, more than a quarter of all silver officially designated as available for delivery in New York simply disappeared from the vaults. It did not evaporate. It did not vanish. It moved eastward, carried by the gravitational pull of a premium so large that it made economic sense for traders, arbitrageurs, and institutions to physically ship metal from American warehouses to Asian buyers willing to pay significantly more for it. The incentive was enormous. The movement was rapid. And the consequence was that the Western supply cushion, the buffer that global markets depend upon to function smoothly, began thinning in ways that had not been seen in recent memory. Simultaneously, on the other side of the Atlantic, the London silver lending market began behaving in a manner that alarmed those watching it closely. London operates one of the world's most important over-the-counter silver markets, and within that market exists a mechanism known as the lease rate, the cost at which institutions can borrow physical silver for a defined period of time. Under calm, well-supplied market conditions, this rate sits comfortably between 0.3 and 0.5% annually. It is low because silver is assumed to be available. Borrowing it carries almost no premium because the vaults are expected to hold sufficient inventory. In early 2026, that assumption was demolished. London silver lease rates did not edge upward politely. They exploded, surging to somewhere between 7 and 8%. To translate that into human terms, the cost of borrowing silver increased by more than 15 times its normal rate within a compressed window of time. This does not happen in a market that is functioning normally. This happens in a market where institutions that need silver to fulfill obligations, deliveries, hedges, contractual commitments are suddenly competing desperately against one another for a metal that is becoming genuinely scarce. The vaults were thinning. The lease rates were screaming, and in Shanghai the premium continued to hold, confirming that the hunger for physical silver on the eastern side of the global supply chain had not diminished in the slightest. What emerged from these 3 simultaneous stress signals, the COMEX withdrawal, the London lease rate spike, and the Shanghai premium, was a picture that seasoned analysts found deeply significant. These were not 3 separate, unrelated events. They were 3 symptoms of one condition. The global silver supply architecture, built on assumptions of steady inventory, reliable lending, and balanced east-west flow, was operating under a strain it had not been designed to sustain indefinitely. There is a particular danger that market participants face in moments like these. It is the danger of normalization, the tendency to look at extraordinary data, and because it has persisted for several weeks without producing a visible catastrophe, begin treating it as ordinary. Traders begin adjusting, models begin adapting, and the urgency of the signal begins to fade precisely at the moment when it should be intensifying. That normalization was beginning to settle in when the Shanghai premium abruptly changed, and it reminded every serious observer of one uncomfortable truth. A fracture that has been spreading quietly does not announce itself before it widens. It simply widens. There's a moment in every complex market event when the data stops telling a single story and begins telling several simultaneously, convincingly, and with equal authority. This is precisely what makes the abrupt collapse of the Shanghai silver premium so analytically significant. It is not the collapse itself that demands attention. Collapses happen. Premiums rise and fall. Numbers move. What demands attention is the reason behind this particular collapse, because depending on which reason is correct, the next move in silver will be entirely different. And the decision maker who misreads the interpretation will position themselves on the wrong side of a market that, as the previous weeks have already demonstrated, moves with extraordinary speed when it decides to move. There are 3 interpretations. Each one is credible. Each one is supported by logic, and each one leads to a completely different conclusion. The most bullish reading of the data. The first interpretation begins with a simple and elegant premise. The system worked. For weeks, Shanghai screamed for physical silver. It paid extraordinary premiums. It pulled metal aggressively from Western vaults. It sent lease rates into territory that shocked even seasoned professionals. And all of that aggressive, relentless buying may have ultimately accomplished exactly what it was designed to accomplish. It brought enough silver eastward to temporarily satisfy the most urgent wave of Chinese demand. Under this interpretation, the premium did not collapse because the shortage ended. The shortage has not ended. The structural deficit between global silver supply and accelerating industrial demand driven by solar energy expansion, electronics manufacturing, and the electrification of transportation remains firmly in place. None of those forces reversed overnight. What reversed was the acute desperation of the most urgent buyers. The pressure valve was released. The warehouses received enough incoming metal to stabilize operations temporarily, and without that acute desperation driving bids higher, the premium naturally compressed. If this interpretation is correct, then what the market is currently experiencing is a pause, not a reversal, a breath between waves. And historically, pauses of this nature in physically tight markets have represented precisely the kind of entry opportunity that disciplined, informed participants wait for. The dip under this reading is not a warning. It is an invitation, the most tactically sophisticated and most unsettling reading. The second interpretation requires one to think not like an analyst watching a screen, but like a senior procurement officer inside a large Chinese industrial conglomerate. Someone who has been watching silver prices move violently upward through early 2026. Someone who has access to internal demand forecasts, inventory levels, and critically a long institutional memory of how commodity price cycles behave. That person looks at the current price level and makes a calculation, not an emotional one, a cold, methodical one. They calculate that silver, after its extraordinary run, is vulnerable to a short-term correction. They calculate that if they simply stop buying, if they pull their bids, let the Western paper market lose its Eastern support and weight, prices may fall 10, 12, perhaps 15% from current levels before the next structural wave begins. And at that lower price, they can accumulate the same physical metal they need anyway, but at a significantly reduced cost. This is not speculation. This is strategic patience. It is the behavior of sophisticated, well-capitalized buyers who operate on long planning horizons and who understand that in physical commodity markets, the timing of demand is itself a form of leverage. If enough major Chinese buyers made the same calculation simultaneously, and in a market as concentrated as China's industrial silver procurement, simultaneous recalibration among major players is entirely possible. Then the premium collapse was not organic. It was engineered not through fraud or manipulation in the legal sense, but through the entirely rational and coordinated withdrawal of demand by actors who decided the price was too high to justify immediate action. Under this interpretation, the next 24 to 48 hours carry real downside risk. The Western paper market, stripped of the Eastern premium support that had been underpinning sentiment, becomes vulnerable to selling pressure. And in a market already running on tight nerves and thin inventories, selling pressure does not need to be large to produce significant price movement. The patient predator under this reading is simply waiting, the most structurally significant and least discussed possibility. The third interpretation is the one that receives the least attention in mainstream financial commentary, which is precisely why serious analysts must give it the most careful consideration. What if the premium collapse was not driven by buyers at all? What if it was driven by supply-side intervention, a deliberate policy-level decision by Chinese authorities, financial regulators, or state-adjacent institutions to cool the premium artificially? China has both the institutional mechanisms and the historical precedent for intervening in commodity markets when domestic price signals become inconvenient, when premiums attract international attention, invite capital flow scrutiny, or signal supply vulnerabilities that authorities would prefer remain opaque. Under this interpretation, the collapse of the Shanghai premium is not a market signal. It is a managed communication, a deliberate dampening of a signal that was becoming too loud, too visible, and too revealing about the true state of Chinese physical silver reserves and industrial supply chains. If this is what occurred, then the underlying shortage has not eased in the slightest. The fracture documented in Part 2 remains fully intact, and the premium will return, perhaps not immediately, perhaps not visibly, but the structural pressure that created it has not been resolved. It has simply been quieted. There's a particular kind of silence that falls over serious decision-makers when a major market signal arrives. It is not the silence of confusion. It is not the silence of fear. It is the silence of calculation. The moment when a disciplined mind stops reacting and starts thinking. The abrupt change in the Shanghai silver premium is precisely that kind of moment. And the question it places in front of every business leader, investor, and aspiring entrepreneur watching this unfold is not simply what happened. The question is, what do you do with what you now know? The first and most important move any serious decision maker can make right now is what experienced analysts call a supply chain exposure audit. This means sitting down quietly, honestly, without assumptions, and asking a direct question. Does the business, portfolio, or operation that depends on this analysis have any connection to silver? Not necessarily as an investment, as a material. Silver is not merely a financial asset. It is an industrial input embedded inside solar panels, semiconductors, electric vehicle components, medical devices, and advanced electronics. Any business operating inside these sectors that has not yet examined its silver procurement pipeline is operating with a blind spot, that this moment has just made considerably more dangerous. The second consideration is one that separates reactive participants from strategic ones. The three interpretations outlined in the previous part of this analysis, temporary demand satisfaction, deliberate buyer withdrawal, and structural supply intervention, each point toward a different operational posture. If the premium collapsed because Chinese demand was temporarily satisfied, the window for strategic positioning is narrow and closing. If it collapsed because sophisticated buyers are waiting for lower prices, then patience becomes the most valuable tool available. And if the collapse reflects something deeper, a policy-level repositioning by major institutional or governmental actors, then the implications extend far beyond the next 24 hours and demand a longer-term strategic review. The third dimension of this moment is the one that most casual observers miss entirely. Silver occupies a dual role in the global economy that almost no other commodity shares. It is simultaneously an industrial raw material and a monetary asset, a store of value with thousands of years of financial history behind it. When stress appears in the physical silver market, it therefore carries two separate warnings at once: a warning to industries that depend on it as an input, and a warning to capital allocators who use it as a hedge against systemic financial instability. Both warnings are present in this moment. Both deserve attention. For the aspiring entrepreneur watching this analysis, the lesson is perhaps the most transferable of all. Markets communicate through data. They speak in premiums, lease rates, inventory drawdowns, and price differentials. The majority of people in the world do not know how to listen to that language. They see headlines. They see numbers moving on screens, but they do not see the story beneath the story. The structural shifts, the supply chain pressures, the strategic pauses of sophisticated buyers that ultimately determine where prices go next. The individual who invests the time to develop that kind of reading, who trains themselves to look past the surface of a market update and understand its deeper mechanics, does not simply become a better investor. They become a better thinker. And in a business environment of accelerating complexity and compressed decision windows, the quality of one's thinking is ultimately the only sustainable competitive advantage that exists. The Shanghai silver premium changed abruptly. The signal has been delivered. The fracture in the supply chain has been documented, the three possible interpretations have been laid out with clarity, and the strategic response framework is now in front of every person watching this analysis. What happens next depends entirely on what they choose to do with